If you work in finance, or you want to, you have heard the terms AAA, BBB, or junk bond. These are credit ratings, and if you want to understand how institutional investors evaluate bonds, understanding credit ratings is essential. In this video, I am going to explain what credit ratings are, how the three major rating agencies work, and why ratings matter so much for institutional fixed income investors. Let's start with the basic definition. A credit rating is an opinion about the likelihood that a bond issuer will meet its debt obligations. It is assigned by a rating agency after a detailed analysis of the issuer's financial health, business model, and the structure of the specific bond. The three agencies that dominate the global credit rating industry are Moody's, Standard & Poor's, and Fitch. Their ratings are deeply embedded in financial regulation and institutional investment mandates worldwide. Many institutional mandates explicitly require a minimum rating from at least one of these agencies before a bond can be purchased. Each agency uses a slightly different rating scale, though the scales are broadly comparable. Both scales run from the highest quality at the top to default at the bottom, with investment grade ratings in the upper portion and high yield or speculative grade ratings in the lower portion. The most important threshold in the entire rating scale is the investment grade boundary. For Moody's, this is their equivalent of BBB- in Standard & Poor's terminology. Anything above this threshold is investment grade. Anything below is high yield, also called speculative grade or junk. This threshold matters enormously for institutional investors because most mandates specify a minimum investment grade rating. A bond that falls below this threshold, an event called a fallen angel, can trigger forced selling by institutional investors regardless of their own fundamental view on the credit. So how do rating agencies actually arrive at a rating? The process begins with the issuer requesting a rating. The agency assigns an analytical team who conduct detailed research into the issuer's business, financial performance, and industry dynamics. For corporate issuers, this covers the same framework we discuss in our credit analysis content: business risk, financial risk, and structural risk. The team then presents their analysis to a rating committee. This committee, composed of senior analysts not directly involved in the day-to-day coverage of the issuer, reviews the analysis and votes on the final rating. This structure is designed to ensure consistency and independence. Once assigned, ratings are not static. Agencies conduct ongoing surveillance, reviewing each rated issuer at least once per year, and more frequently when significant events occur. There are three important signals beyond the rating itself that institutional investors monitor closely. The first is the rating outlook. This can be positive, negative, or stable, and indicates the likely direction of any future rating change over the next 1 to 2 years. A negative outlook is a warning that a downgrade may be coming. The second is the rating watch. This is a more urgent signal, used when a specific event makes a rating change, likely within just a few months. Being placed on negative watch often causes immediate spread widening in the bond market. The third is split ratings, when different agencies assign different ratings to the same issuer. Institutional mandates specify how to handle this, often by using the lowest available rating or requiring a minimum from at least 2 agencies. Now let me address something important about what credit ratings are not. A credit rating is an opinion, not a guarantee. Rating agencies are generally protected from legal liability for rating opinions that later prove incorrect. And as the 2008 financial crisis demonstrated dramatically, ratings can be wrong. Structured products received the highest possible ratings that proved dramatically mismatched with their underlying risk. This is why regulators and institutional investors now explicitly require independent credit assessment rather rather than mechanically relying on agency ratings alone. Under Solvency II in Europe and equivalent frameworks elsewhere, institutional investors must conduct their own fundamental analysis. Ratings are a starting point, not a conclusion. Understanding credit ratings is the foundation of institutional fixed income analysis. They define the investment universe, shape mandate constraints, and provide a common language for discussing credit risk across markets and geographies. But they are one input among many, not a substitute for the deeper analysis that experienced institutional credit professionals conduct every day. If you want to go deeper into how institutional investors analyze credit risk beyond the rating, how to read a prospectus, how to evaluate financial statements, and how to identify red flags before they show up in a downgrade, subscribe to this channel, and if you want a structured learning path, check the link in the description.